Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive into the machinery of the market. We have been looking forward to this one for a long, long time because it really touches on the intersection of healthcare, heavy engineering, and, well, absolute monopoly power.
It's a fascinating one.
Today, we're breaking down one of the most interesting and, frankly, expensive companies on the market. The undisputed king of robotic-assisted surgery, Intuitive Surgical, ticker symbol ISRG.
The one and only.
And look, on the surface, this is the perfect monopoly. I mean, you've got a fortress balance sheet, a product that literally saves lives,
Yeah.
and a competitive position that just looks unassailable.
You're perfect.
But the real question for us as long-term investors is this. Are we looking at an infinite compounder that truly deserves its massive premium? Or is this a hardware monopoly about to face its Kodak moment as the world shifts to AI and software? That's what we're here to find out.
That's a huge topic, and the stakes are incredibly high given where that valuation is sitting right now.
They really are.
Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest in any of these names, we use Interactive Brokers. You can use the link in the description, and you'll get a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. Really helps us out.
And while you're there, please like the video, subscribe to the channel, and let us know your questions in the comments below. We read all of them.
Now let's get into it. Pillar number one, the business engine. And I think we have to start by dispelling a myth, don't we?
Absolutely, 100%. If you ask the average person on the street, or even a casual retail investor what Intuitive Surgical does, they'll tell you they sell robots.
They sell the Da Vinci.
Yeah, they sell the Da Vinci system. And they aren't wrong, technically. The Da Vinci is the face of the brand. It's this massive, futuristic console where a surgeon sits controlling these robotic arms with just microscopic precision. It looks like something out of sci-fi.
It really does.
But if you think the business model is selling robots, you are missing the entire story, the whole thing.
Exactly. Selling the robot is actually the least interesting part of the economics here. The robot is just the razor.
Right.
It's a very expensive, multi-million-dollar razor, costing anywhere from $1.5 to $2.5 million per unit. But it's still just the razor.
Mm-hmm.
The real economic engine, the thing that makes this stock trade at the multiples it does, is the blades.
And when we say blades, we're talking about the single-use instruments, the accessories, the drapes, the staples, and, of course, the maintenance contracts.
Yeah.
Every single time a surgery is performed using a Da Vinci, Intuitive gets paid.
They get a cut.
It is a toll booth on modern surgery. It's as simple as that.
And let's get specific on the technology here, because this isn't just a scalpel you can, throw in the dishwasher and reuse. These are the endowrist instruments. The are proprietary articulated tools that snap onto the robot arms. And here is the critical insight that I think most people miss.
Yeah.
These instruments have a microchip inside them.
A microchip in a surgical tool.
Yes. It's essentially a kill switch. You can think of it as digital rights management, or DRM, for surgery.
Wow.
This chip counts the number of times the instrument is used. Most of these tools are rated for exactly 10 lives.
10 uses.
10 uses. You use it for a surgery, that's one life gone. Once that counter hits 0, the robot physically refuses to accept the instrument. The software locks it out. It becomes a paperweight.
That sounds incredibly aggressive. Is that purely for profit, or is there a legitimate medical reason for that?
Well, that's the genius of it. It's both. The legitimate reason they'll give you is metal fatigue. These instruments are built with these tiny little cables and pulleys. If a cable snaps inside a patient...
Oh, that's a catastrophe.
That is a catastrophic lawsuit and an absolute tragedy. So they force retirement of the tool before failure is statistically likely. But conveniently for the shareholder, it also guarantees a recurring revenue stream that no competitor can undercut with generic knockoffs.
Because the software handshake prevents it.
Exactly. The robot just won't talk to a third-party tool.
That context completely changes how you view the revenue mix. And the data, data backs this up beautifully.
Mm-hmm.
If you look at the 2024 numbers, 84% of their total revenue was recurring.
84%.
Just pause and think about that for a second. 84%.
Mm-hmm.
In the world of hardware, that is the holy grail.
It's unheard of.
Usually, hardware is a feast or famine cycle, right? You sell the machine, then you have to go find a new customer. Intuitive is flip that completely on its head. They sell the machine once, and then they monetize that single relationship for a decade or more.
It totally changes the risk profile of the business. I mean, think about it. If they didn't sell a single new robot next quarter, which obviously won't happen, but just hypothetically, if system sales went to zero,
Yeah.
they would still be generating billions of dollars from the installed base just from procedures happening every single day.
It's incredible.
It transforms a cyclical industrial company into something that looks a lot closer to a SaaS business, a software as a service business.
Which is why it gets that SaaS multiple. And that leads us right to the concept of pricing power. We hear this term thrown around a lot on, financial news or in analyst notes, but let's define what it actually looks like in practice here.
Okay.
Usually in hardware manufacturing, margins degrade over time. Competition comes in, components get cheaper, and you have to lower your prices to move volume. It's just gravity.
But ISRG has completely bucked that trend. They possess what I'd call deep traditional pricing power. Even with all the global supply chain chaos we've seen over the last few years, inflation, tariffs, shipping costs just skyrocketed.
Yeah, a nightmare for manufacturers.
A total nightmare. And yet, they have maintained gross margins between 66% and 69.1%.
That is a software-like margin profile for a company that is bending metal and shipping physical goods around the world. It tells you everything you need to know about their relationship with their customers, the hospitals.
They just pass the costs on.
They pass those costs right on, and the hospitals didn't blink. Volume didn't drop. That is the definition of an inelastic demand curve.
It really is, but we have to ask the question, why?
Right.
Why do hospitals accept this? Why don't they just switch to a competitor or go back to traditional laparoscopy? This leads us to the Lollapalooza moat.
I love that term. It's a classic Charlie Munger concept, isn't it?
It is.
The Lollapalooza effect is when you have multiple forces, psychological, economic, structural, all pushing in the exact same direction at the same time. The result isn't just a linear advantage. It's a geometric nonlinear dominance.
So let's break down those forces. The first one, and in my opinion the strongest, is switching costs.
Okay.
In the 7 powers framework, this is power number 4.
Right.
But it's not just financial switching costs we're talking about here. It is deeply physical.
Right. We aren't talking about switching from, say, Slack to Microsoft Teams where everyone grumbles for a week and then they just get over it.
No.
We are talking about surgeons who have spent hundreds, maybe thousands of hours mastering the physical interface of the Da Vinci.
And we should probably explain that interface because it's pretty unique. The surgeon sits at a console, totally separate from the patient, looking into a stereoscopic 3D viewer.
Like a high-tech ViewMaster.
Exactly. And they pinch these master controllers with their fingers. The robot takes that movement, filters out any hand tremors. So if the surgeon had a bit too much coffee that morning, the robot doesn't shake. And it scales the motion down. A 3-inch movement of the surgeon's hand becomes a 1 millimeter movement of the instrument inside the patient.
It's pure muscle memory. It's like learning to play the violin or learning a new language. Once a surgeon is trained on Da Vinci, they are fluent in that physical language.
They are.
So to switch to a competitor, a hospital would have to tell their star surgeons, who, by the way, bring in all the revenue, hey, forget everything your hands know. We're going to retrain you on this new system just to save a few bucks.
That is a conversation that no hospital administrator ever wants to have. Yeah. It risks patient outcomes. It risks operational speed. It risks the surgeon just leaving and going to another hospital that does have a Da Vinci. That friction is massive. It creates a lock-in that is almost biological.
Then you layer on the second force, structural scale. They have an installed base of over 10,600 systems globally.
It's huge.
This allows them to distribute their massive R&D costs over a much wider base than any competitor could ever hope to. If a new entrant wants to compete, they have to spend the same R&D dollars, but amortize it over, 0 systems.
The unit economics for a challenger are just brutal. Impossible at the start.
And the third force?
The third force is the cornered resource, or power number 6. Their IP and patent portfolio is just a fortress. They have been doing this for over 2 decades. They have patented the mechanisms, the software, the vision systems, everything.
That's a minefield.
It is a legal minefield for anyone trying to engineer a workaround. Every time a competitor tries to launch a new robot, they inevitably run into an intuitive patent lawsuit. It's just part of the playbook.
However, we have to play devil's advocate here. It's what we do. We have to look for the cracks. Is there an anti-moat developing? Are hospitals getting tired of being locked in this ecosystem?
It's a very valid question. And you often hear the bear case that commoditization is coming, that eventually someone will break through.
Right.
But when we check the actual data, The moat looks like it's widening, not shrinking. Look at the integrated delivery networks, the IDNs.
The big hospital chains.
Exactly, the massive hospital chains. The number of IDNs that own 20 or more Da Vinci systems, that number grew by 16% year over year.
Wow. Okay. That is a key metric right there.
It is.
Because it signals deeper entrenchment. These large networks aren't just dabbling in robotics anymore. They are standardizing on intuitive. They're going all in. If they were looking for alternatives, you wouldn't see that concentration increasing.
That's a great point. They're standardizing their supply chains, their training protocols, their maintenance contracts, all on one single vendor.
It's the opposite of commoditization. It's standardization. It creates a network effect within the hospital system itself.
It does.
Now, before we move to the financials, I just want to touch on the soft power aspect, the culture and the brand. Because ultimately, companies are made of people. If the culture is rotten, the moat will eventually crumble from the inside out.
And this is a bit of a mixed bag, to be honest with you. If we look at the inside view from a site like Glassdoor, the rating is pretty solid. It's a 3.7 out of 5.
Okay.
Employees talk about a high-performance culture, and very importantly, they are deeply aligned with the mission. They know they are building machines that save lives. That purpose is a really powerful motivator.
Like you're a butt coming.
But
yeah,
there are some red flags. You see recurring complaints about an intense sales culture, about micromanagement. There's talk of unrealistic growth expectations being pushed down from the top.
That's not totally uncommon in high-growth medtech, though, is it? I mean, it's a high-pressure environment by nature.
It is standard, yes, but it's something to monitor. If that pressure turns into burnout, or if it leads to aggressive sales tactics that start to alienate the hospitals, that soft power can erode very quickly. We've seen it happen in pharma. We've seen it happen in other medical device companies. You have to watch it.
So something to keep an eye on. But what about from the customer side?
From the customer side, churn is effectively zero, and utilization is soaring. Procedures were up 17% year over year in 2024. That's 2.7 million surgeries.
2.7 million.
Yeah.
That is just a staggering number of people interacting with this technology.
Right.
So, okay, the business engine is humming. The moat is deep and getting wider. But now we have to look at the scoreboard. Let's move to pillar number 2, financial resilience and the quality of earnings.
Let's follow the money. And I want to be very precise here because the headline numbers, I think, can be a little deceiving.
Okay, so revenue is compounding at a 13.5% CAGR. That's healthy double-digit growth. But if you look closely at the operating margins, they have compressed. We used to see margins in the mid-30s.
Right.
Now we're looking at something in the 29% to 30% range.
And usually margin compression is a death knell for a stock like this. It usually means you're losing pricing power or your costs are just spiraling out of control. It screams inefficiency. But here, the context is absolutely vital. Why are margins down? Is the business failing? No, it's a deliberate choice.
It's the R&D spend, isn't it?
Exactly. They are currently pouring about 14% of their revenue back into research and development.
Which is massive. I mean, for a company of this scale, 14% is a huge commitment.
It is. But they're doing this to launch the Da Vinci 5, the next generation system. This is what we call good margin compression.
I like that term.
They are sacrificing short-term profitability to secure dominance for the next decade. The Da Vinci 5 adds things like force feedback, so the surgeon can actually feel the tissue they're working on, and massive computing power upgrades.
So if they cut R&D to boost margins today, they would be leaving the door wide open for competitors tomorrow.
They'd be harvesting the business, not growing it. I agree with the strategy, but I'm going to drop the hammer on something that I think Wall Street ignores way, way too often.
I had a feeling you were going to bring this up.
And that is stock-based compensation, or SBC.
The elephant in the room.
It's the elephant in the room for practically every tech-adjacent company based in California. In 2023, Intuitive's SBC grew to $593 million. That is up 15% year over year.
Okay, cool. Let's contextualize that. I mean, almost $600 million sounds like a lot, but for a company this size, is it breaking the bank?
It's not breaking the bank, no, but it is distorting the valuation. Intuitive generates incredible free cash flow, about $2.49 billion on a trailing 12-month basis. But SBC eats up roughly 20% to 25% of that cash generation.
So essentially, a quarter of the cash flow is being paid out to employees in the form of stock, which dilutes the existing shareholders.
Precisely. And when you look at the adjusted earnings numbers that all the analysts love to quote, they often add that SBC back in as if it's not a real expense. But it is a real expense.
It is.
It's dilution. If you own a slice of the pizza and the company keeps cutting more slices to give to its employees, your slice just gets smaller over time. So the earnings aren't fake, the company is wildly profitable, but the true owner earnings, the cash that belongs to us as shareholders, is significantly lower than the headline GAAP numbers might suggest.
That's a very fair critique. You have to account for that dilution when you run your models. But let's flip to the other side of the ledger for a second. The balance sheet. This is my sleep well at night factor.
Oh, it is a fortress. It is a bunker. There's no other way to describe it. They have $9.03 billion in cash and investments.
$9 billion.
And debt. Zero.
Zero. Not a penny.
A 0.000 debt-to-equity ratio. In a world of high interest rates where other companies are getting absolutely crushed by debt servicing costs, Intuitive is sitting on a mountain of cash, actually earning interest income.
And this also impacts how we view their return on invested capital, or ROIC, doesn't it? Because they use zero leverage, there's no financial engineering going on here, their ROIC is a pure reflection of operational excellence.
Right. They aren't juicing the returns with debt, which is what a lot of companies do, and that ROIC comfortably exceeds their cost of capital year after year. They are creating true economic value with every single dollar they deploy.
So how are they spending that cash? If they aren't paying down debt, where is it all going?
Well, the capital allocation report card is very, very disciplined. Hierarchy number 1 is organic growth. That's the R&D we just talked about. That has the highest ROI for them. Hierarchy number 2 is M&A, but they are very careful here. You don't see them doing reckless diversification, buying random companies just to show top-line growth.
And then buybacks.
They do buybacks, but mostly just to offset the SBC dilution we talked about earlier. They aren't aggressively shrinking the float, which, frankly, given the valuation, is probably the smart move. You don't want to be buying back your own stock when it's this expensive. That destroys value.
Which is the perfect segue to pillar number 3, the valuation. Because expensive is the word of the day here.
This is where the rubber meets the road. We've established it's a great business, a phenomenal business, but is it a great investment?
Two very different questions.
Very different questions.
Let's look at the growth engines first. Where is the future cash going to come from? We have the upgrade cycle to the Da Vinci 5. That's the big one. Then we have the Ion platform, which is their system for lung biopsy. Totally different form factor, huge potential for early cancer detection, and then just the general expansion into new procedure types like cardiac and emergent surgeries.
Those are all real growth drivers, no question. Yeah. But I have to play the bear here for a moment. We have to respect the base rate.
The law of large numbers.
Exactly. Intuitive is now generating over $10 billion in annual revenue. Gravity applies. It is incredibly difficult for a company of that size to keep growing at 15% or 20% forever. The law of large numbers eventually pulls you back down to a mean.
A mature mean of, what, say 9% to 11%.
Exactly. Which is still fantastic growth. But the problem is the price you are being asked to pay for that growth.
And the price is, the stock is trading at roughly 60 times trailing 12-month earnings, 60, and nearly 50 times forward earnings.
That is just nosebleed territory. For context, the S&P 500 average is somewhere around 20 or 21 times earnings. Intuitive is trading at triple the market multiple. That is a valuation that implies absolute perfection.
So what is the market wagering here? When someone clicks buy on ISRG at $485 a share, what are they implicitly betting on?
They are betting that Intuitive will defy gravity. They are betting that ISRG will continue to grow at 15% plus for another full decade without any significant margin degradation and without any serious competition finally showing up. It is priced for a flawless execution scenario.
So let's try to triangulate a fair value. If we strip away the euphoria, if we try to be rational, what is this thing actually worth?
Okay, let's run the numbers a couple of ways. Method A, mean reversion. Historically, ISRG has traded at a premium because it's a monopoly, right? So let's be generous and say a 45x PE is fair, which is still very, very high. If we apply that to their forward earnings estimates, we get a stock price of about $525. So maybe it's fairly valued today if you believe that premium is permanent and deserved.
Okay, but what if we look at it like a more traditional value investor, based on owner earnings?
Right, that's method B. If we take the free cash flow of roughly $2.5 billion and we apply a mature, steady-state multiple of, say, 35x, which is still very generous for an industrial company, We get a market cap that implies a share price of roughly $246.
Ouch. $246 versus the current trading price of roughly $485. That is a massive gap.
It is. And that tells me that at the current price, there is absolute zero margin of safety. If anything goes wrong, if growth slows from 15% to 12%, if a competitor finally gets a foothold and takes 5% market share, the stock gets crushed.
So where is the buy zone? If we are disciplined, patient investors, where do we set our price alerts and just wait?
For me, to protect permanent capital, I'm looking at the $320 to $380 range.
Okay.
That's where the valuation starts to reflect reality rather than euphoria. That's where you're getting paid to take on some of the risk.
That requires patience. A lot of patience.
Investing is mostly waiting. You make your money when you buy, not when you sell.
True words. Now, I want to do a pre-mortem. This is an exercise I love. We assume the investment has died in 5 years, and we work backwards to ask, how did it happen?
It's a great inversion technique. So, okay, it's 2031, and ISRG stock has collapsed. What happened? Scenario number 1 is what I'd call tech counterpositioning.
This is the classic disruption narrative.
Right. Imagine a competitor, maybe it's Medtronic finally getting their act together, maybe it's a new startup we haven't even heard of yet, launches a system that isn't just as good as the Da Vinci, but is fundamentally different. Maybe it's modular, maybe it's heavily AI-driven, and crucially, maybe it costs a fraction of the price.
If they can break that hardware lock-in by offering a system that costs, say, $500,000 instead of $2.5 million, hospitals might finally have a real reason to switch.
Exactly. It would completely destroy the pricing power. If the hardware becomes cheap, Intuitive can't charge $3,000 per surgery for instruments anymore, the entire economic model collapses.
And what's scenario 2?
Scenario 2 is the reflexive multiplier collapse. This one is purely financial, no disruption needed. Let's say we hit a major macro recession, or Medicare cuts reimbursement rates for robotic surgeries. Hospital CapEx budgets freeze up overnight.
So they just stop buying new robots.
They stop buying new systems. Revenue growth slows from 15% down to, say, 5%. Now, the company is still wildly profitable. They're still selling blades into the install base. But the market looks at that 5% growth and says, this isn't a growth stock anymore. It's a utility.
And the multiple gets cut in half.
The multiple compresses from 60x down to 30x. And just like that, the stock price drops 50%. The underlying company is fine, but the investment is a disaster.
That is the core risk of buying at 60 times earnings. You can be 100% right about the quality of the business and still lose half your money.
That's it.
That is a sobering thought. But let's zoom out. Let's look at the 10-year horizon, pillar number 4, because the company isn't just standing still, right? Yeah. They are pivoting.
This is the paradigm shift. And if you are a long-term bull on this company, this is what you are hanging your hat on. The move from hardware to data.
Looking out to 2031, 2036, the hardware market will eventually saturate. There are only so many operating rooms in the developed world.
Correct. The more systems equals more procedures. Flywheel has a physical limit, so the new moat, the next moat, has to be built on data.
And Intuitive has something that no one else has. They have detailed data from millions and millions of surgeries. They are recording the exact movement of the instruments, the patient outcomes, the visuals from the camera. They're aggregating all of this via platforms like their SimNow simulator.
They are becoming an aggregator, almost like a software company. And the goal is to use that massive data set to offer digital insights, better training, and maybe even real-time surgical guidance.
Imagine an overlay on the surgeon's screen saying, hey, you're about to nick an artery, move 2 millimeters to the left. Or, based on 10,000 previous surgeries just like this one, the tumor is likely located behind this layer of tissue.
And the economics of that are just beautiful. Digital offerings have zero marginal cost. If they can successfully monetize that data, their operating margins could expand back toward 40% or even higher.
That's the bull case dream.
That's the dream. But there is another transition that has to happen. I call it the cannibal transition.
The uber cannibal. This refers to companies that just systematically eat their own stock through buybacks.
Right. As we said, right now, they only buy back stock to offset the SBC dilution. But in 10 years, as that hardware growth inevitably slows, their CapEx needs will fall. They won't need to build as many new factories or R&D centers. Cash is going to pile up on the balance sheet.
We're talking mountains of cash.
Exactly. And the ultimate test of this management team will be, what do they do with it? If they become an Uber cannibal and systematically retire 3% to 5% of the float annually, and crucially, do it at rational valuations, they can turbocharge their earnings per share. They can essentially manufacture growth even if the top line is flat.
But there is a huge trap there, isn't there?
The trap is the valuation. If they start buying back stock aggressively when it's trading at 60x earnings, they are just destroying value. They're lighting shareholder money on fire. They need to have the discipline to wait for the stock to be cheap.
Which is hard for a management team to do.
Very hard.
Before we wrap up, I want to throw one final challenge at you. The red team challenge. The AI threat.
This is the existential one, I think. The bull case for Intuitive relies heavily on survivorship bias. We assume that because all the competitors have failed in the past, they will continue to fail in the future.
But the past was about hardware, right? The challenge in the past was, can you build a robot arm that doesn't shake and is reliable? The future is about software.
Exactly. Surgery is moving from being a mechanical problem. How do I move this tissue from point A to point B to a data problem? Where is the cancer? What is the optimal surgical path? If the core problem shifts to software, the hardware dominance matters a lot less.
So an investor buying at $485 today is paying a massive premium for a hardware monopoly just at the moment the industry might be shifting toward AI-driven commoditization. That is the scary thought.
It is. You might be buying the best buggy whip manufacturer in the world just as the Model T is rolling off the assembly line. If the intelligence moves from the robot to the cloud, having the best mechanical wrist might not command a $2 million price tag anymore.
So let's bring this all home, the outro. Let's synthesize this for the listener.
Okay. If we had to give it a score, a report card.
The quality score, high, A+. This is an apex compounder. Impregnable moat, elite balance sheet, 84% recurring revenue. It is a beautiful, beautiful business.
Valuation score, expensive, very expensive. I'd give it a D-, maybe an F.
So the bull case is simple. Unassailable switching costs, a recurring revenue machine, and a pristine balance sheet. It's a fortress.
And the bear case is just as simple. Margin compression due to necessary R&D, priced at peak multiples, and extremely vulnerable to that multiple crunch if growth slows down even a tiny bit.
It's the classic case of great company, tough price.
Precisely. And I want to leave the listener with a final provocative thought to chew on.
Go for it.
We know the robot can see better than the surgeon. We know it can cut cleaner than a human hand. But the market is valuing this company as if it has already won the future. The question you have to ask yourself is, are you being paid to take the risk that the future looks different than the past? At 60 times earnings, I don't think you are. When you buy at these levels, you aren't an investor, you're an optimist. And in the stock market, optimists usually get the bill.
That is the question to sleep on. Thank you all for tuning in to this deep dive on Intuitive Surgical. As always, check the description for the detailed notes and that broker link.
See you in the next deep dive.